This is the weekly market review for the week ending Friday, January 9, 2026. The narrative on Wall Street has shifted. For the last 2 years, the market's heartbeat was almost exclusively synchronized with the Mag 7 and AI capex. But this past week, we saw the strongest evidence yet of a genuine broadening in market breadth. We just closed the first full trading week of 2026 with the S&P 500 and Dow Jones Industrial Average hitting fresh all-time highs, driven not just by tech, but by a rotation into cyclicals, housing, and energy. If you've been waiting for the rally to democratize beyond Silicon Valley, this was your week. Let's look at the numbers. The S&P 500 finished the week up approximately 1.6%, closing right around the 6,966 level. The Dow Jones Industrial Average led the charge, gaining 2.3% to close just above 49,500. The Nasdaq Composite also participated, adding 1.9% to settle near 23,670, though notably, it faced some headwinds midweek as investors took profits in semiconductor heavyweights to fund positions in value sectors. The primary catalyst for this move was Friday's December jobs report. The headline number initially looked soft. Payrolls missed expectations, showing hiring is slowing down. However, the institutional money looked past the headline and focused on the unemployment rate, which ticked lower. This created a Goldilocks scenario. The labor market is cooling enough to keep the Federal Reserve from turning hawkish, but it remains resilient enough to ward off recession fears. The bond market reaction was mixed, but equities took it as a green light to bid up risk assets. However, the real story this week wasn't the macro data. It was the sector-level rotation driven by policy headlines and strategic corporate deals. First, we saw a massive repricing in the housing and mortgage sector. Late in the week, President Trump floated a proposal for government-sponsored enterprises to purchase $200 billion in mortgage bonds. While details remain light, the market front-ran the policy immediately. Stocks like rocket companies and Open Door surged, and home builders like Lennar caught a bid. The smart money is positioning for a potential liquidity injection into the housing market, which could reignite transaction volumes in 2026. Second, the energy transition trade is evolving. We saw a standout move in the nuclear sector, highlighted by Vistra and Oklo. Both surged after Meta Platforms announced it would back nuclear projects to power its AI data centers. This confirms a thesis we have tracked for months. Big Tech's AI ambitions are now directly colliding with the physical constraints of the power grid. Utilities and nuclear names are no longer just defensive dividend plays, they are becoming critical infrastructure growth plays. Conversely, we saw weakness in some semiconductor names, including Nvidia and AMD, earlier in the week. This wasn't a collapse, but rather a healthy digestion. Portfolio managers are rebalancing. When you see the Dow outperforming the Nasdaq, it tells you that capital is moving from crowded growth trades into real economy sectors, industrials, financials, and energy, that look far cheaper on a price-to-earnings basis. Looking ahead to next week, the training wheels come off. We move from sentiment to hard data. The economic calendar for the week of January 12th is headlined by the Consumer Price Index, CPI, report on Tuesday. The market is pricing in continued disinflation, but any upside surprise in core services inflation could rattle the bond market and challenge these new record highs. Following that, we get the Producer Price Index, PPI, and retail sales on Wednesday, which will give us a read on the health of the consumer post-holiday. Finally, earnings season unofficially kicks off. We will see reports from the major money center banks, including J.P. Morgan Chase, Bank of America, and Wells Fargo. Institutional investors will be scrutinizing their guidance on loan demand and credit quality. If the banks signal that the consumer is cracking, the soft landing narrative will be tested. In summary, the market is currently priced for perfection. Record highs, cooling inflation, and a supportive policy backdrop. Position accordingly, but stay alert for volatility as the earnings reality check begins. I'll see you next week.